back on Fund Launch Live, the daily live stream about the marketing and promotion of roll-in funds and syndicates. As far as I know, not only the only daily live stream about roll-in funds and syndicates, but really the only consistent publication about roll-in funds. Roll-in funds are a fairly new innovation in venture capital, and I really don't see that many other people, or really anyone, talking about roll-in funds with any kind of consistent content output. When they first were announced in 2021, in 2020, there was some splash and some, at least one Substack started about roll-in funds, but seems to have fizzled down. Trying to keep it alive here. So today we're going to be going through some roll-in fund basics through the AngelList Venture FAQ section. We did this yesterday. I think it's good to go through a lot of these FAQs and these roll-in fund basics. I'm not going to be doing it all, so I'm going to make it a regular segment, but I'm not going to be doing it straight through. Probably this will be a weekend thing. As you can tell right now, it's 10:30 a.m., which is a few hours later than when I usually get these streams out, but it's Sunday morning. I woke up late, had some bacon, had some sausage. It was fantastic. Let's get into roll-in funds. So we're at the AngelList Venture Help Center. We're going down into leads because I presume that anyone watching this is interested in one day leading their own roll-in fund. So we're going to get into basics, picking up where we left off from the last live stream, which was yesterday, because this is a daily live stream. So yesterday we ended with, why can roll-in fund GPs talk about their fundraising publicly? And if you want to know the answer to that, you can tune into yesterday's stream. Okay, let's go. How long does it take to set up a roll-in fund? We want to get your roll-in fund live as quickly as you do. As each roll-in fund has its own specifications and potentials for customizations, launch times can be a few days to a few weeks. Your account manager will work with you and any external constraints to make sure your fund is ready when it needs to be. This is something good to bring up. A roll-in fund is a service through AngelList. It's not merely just like a software subscription. You have to apply and you have to be accepted by AngelList. Now, AngelList wants to protect investors. They want to protect their own reputation by making sure that they're not associated with shoddy products. So before you think about launching a fund, make sure you actually have the chops for it. AngelList is going to evaluate that. They're going to make sure that you at least seem like someone who has some degree of competence when it comes to investing, or at least experience in tech. And also that you have some sort of audience who has expressed interest in being part of your fund. So the process to launch a fund is not as simple as just signing up for a software page. You will get sort of a full service treatment through AngelList. You'll have your own account manager, and you have an application that has to be accepted by them. They have to want you on their platform. What happens to uninvested capital at the end of each quarter? If a fund does not deploy all of its capital in one quarter, the balance will generally be rolled automatically into the next fund's quarter as additional capital contributions from the participating LPs. The rolled over capital is not double charged management fees or platform fees. By default, an LP's portion of an uninvested capital will roll into the next quarterly fund unless an LP has canceled their subscription and the fund has more than 90 LPs, or an LP has canceled their subscription and their rollover contribution would be less than 10% of the subscription amount. Example, an LP subscribes at $25K per quarter for 4 quarters. The LP stops their subscription in quarter 5. The GP only invested $50K, inclusive of fees and expenses, of the $100K from that LP in the first 4 quarters. If the fund has more than 90 LPs, the LP's uninvested 50K would be returned at the start of quarter 5. This helps keep funds below investor limits, which we're going to talk about. If the fund has less than 90 LPs, the LP's uninvested 50K would be contributed to the quarter 5 fund. This helps maximize investable capital. The fund manager can override this default policy for any and all LPs upon request. So keep in mind that a rolling fund is a sequence of different funds quarterly. Each fund is each quarter is a new fund, and then the series of quarters are owned by one entity, but each quarter is a distinct sub-entity. So the idea is that if you're subscribing to Sahil's fund in quarter 1, and then you end your subscription, you're exposed to all of the quarter 1 deals, but you're not getting a piece of the quarter 2 deals because you don't have money in that quarter. Unless Sahil fails to spend through a portion of yours and the money rolls over into quarter 2. I guess you could think of that like a free quarter access, although it's with the same amount of money. Two things that I want to point out on this one. First of all, the fund manager can override this default policy for any and all LPs upon request. GPs do have certain privileges to give kind of privileged deals to LPs, to special LPs. A GP can waive fees, can waive management fees for certain LPs. I believe you can alter carry distributions for certain LPs as well. And you can override the rollover policy for LPs. Now, we talked here about investor limits. This is important. Why does this say security check? Oh, you want to make sure that I'm human. There is a limit to how many LPs you can have in your fund. Can't believe I'm being captcha'd on live. Don't they know? Let's see, bus. Okay, let's see if I'm a robot or not. I could be a deep fake. I'm not entirely sure. So guys, this is a great point here. What are the investor limits for rolling funds? You can accept up to 99 accredited investors and up to 1,999 qualified purchasers into your rolling fund. Rolling funds, like the vast majority of private funds, including private equity funds and other venture capital funds, are organized to be exempt from registration as an investment company under the Investment Act of 1940. Exemption from registration allows the fund to avoid the robust disclosure and reporting requirements for a registered fund. As a result, it is often easier, quicker, and more cost-effective to run the fund. To be exempt from this registration, the fund must satisfy a number of requirements set by the SEC. These requirements include certain limits on the number of investors in those funds. The total number of investors allowed in the fund depends on the specific type of fund, which is why you'll see different limitations for funds based on whether the fund accepts accredited investors or qualified purchasers. Let's talk about this different limit here. Accredited investors and qualified purchasers. And I'm actually going to pull up a tweet thread that I made on this same topic. Let's see. I made it a while ago, so it should be down near the bottom here. But it was about the theoretical world's largest fund. Okay. There are two types of rolling fund. Accepts accredited investors exclusively, accepts qualified purchasers exclusively. QPs have bigger pockets, but are a smaller market. So a QP is going to be more analogous to a family office. And I believe the definition for a qualified purchaser is qualified purchaser has 5 million of investable assets. So we're not talking about net worth anymore. An accredited investor can be accredited based on either having a history of earning 200,000 or more in income, or having a net worth excluding primary residence of over $1 million. Whereas QPs are assessed purely based on the investable assets they have, and that needs to be over 5 million. So they're larger whales. There are fewer of them, though. Despite accredited investors outnumbering qualified purchasers in the population, a fund of QPs can have 20 times the number of partners. Max accredited investors per fund, 100. That's if you include the GP as one of the members. Max qualified investors, purchasers per fund, 2,000. A theoretical world's largest rolling fund should be composed of QPs, since they have deeper pockets and you can raise from so many more of them. Oops. Now, there's some discrepancy here on this, the number of accredited investors you can have in your fund. Now, at different times, AngelList has used different numbers for the number of accredited investors you can have in your fund. At one point, they've said that you can have 249 accredited investors, provided that 249 LPs who are accredited investors, provided that your fund is under a limit of 10 million aggregate contributed capital, but that once you go over that $10 million limit, then you're limited to 99 LPs. So kick out about 60% of them, which is odd. Now on the FAQs, they are putting a hard limit of 99. It's possible that they shrunk that just for the sake of confusion, and that it might be technically legal to have, still be legal to have 249 under the $10 million limit, but perhaps AngelList just doesn't want to cause confusion, and they are only accepting 99 maximum now. Okay, I think we're done with that one. How does AngelList calculate the GP commits every quarter? The GP's capital commitment to the fund, or applicable, is generally a percentage of the overall capital commitments to each quarterly fund, excluding rollover contributions from earlier quarters. AngelList does have a minimum for how much you as a GP need to contribute to your fund. It's not terribly much. In fact, they have material stating that the average no, AngelList doesn't have material, but I've heard from other founders and rolling fund leaders that the average GP on rolling funds is throwing in about 1% of the total value, which doesn't sound like terribly much. We'll see if AngelList clarifies that in these FAQs. Why does AngelList collect management fees up front? For administrative efficiency, AngelList takes management fees up front at the beginning of each quarterly fund. Though we take these fees up front, they are held in escrow and paid to a GP over time as set forth in the government documents of the fund. Okay, there's a graph for this, and we went over it yesterday, how our management fees structured within rolling funds. So if you want to see exactly how AngelList takes, so can I zoom in on this? I hope you can see this. So let's just focus where the mouse is here. We have a graph here of a quarter one of 1 quarter of a fund. And again, keep in mind that in a rolling fund, it is a series of separate quarterly funds. So for quarter one, if you are a GP and you solicit LPs, and LPs in total throw in $2 million of capital in quarter one fund, how much do you actually get to invest out of that? Well, AngelList calculates, assuming you're using a standard 2% fee, AngelList takes out 20% of your invested capital. That's because AngelList calculates a 2% fee over the course of 10 years, which they hold in escrow from day one. So 2% fee over 10 years is 20%. If you have $2 million in contributed capital, AngelList is holding $400K in escrow and leaving you with about 1.6 million of the 2 million. Of course, AngelList has their own 1.5% fee, but that's not calculated over 10 years. And then the fee is paid out over 16 quarters. So you have this kind of this weird structure where you take a 2% fee, but it's actually 20% because you calculate it over 10 years. But then you subtract that and those 10 years immediately and hold it in escrow and then pay that out over 4 years or 16 quarters. So of that $400K that AngelList holds in escrow from day one, you see down here in the second graph, they're paying out. They've divided that $400K by 16, which is $25K, and they're paying out the quarter one management fee, $25K in quarter one that you get, and then $25K in quarter two, quarter three, quarter four, and that's going to go on for 4 years. 4 years worth of $25K distributions every quarter, and then that's just for this 1 quarter of the fund. So if you set up a rolling fund in quarter one, you get $2 million in contributed capital, and then you shut down the fund after quarter one. You do not raise a quarter two, which would be a silly rolling fund. But then for the next 4 years, you're still receiving that that distribution over 16 quarters. And then if you do raise a quarter two, then again, that next quarter, that's a new 4-year distribution. So kind of a funny thing where you have a 2% fee over 10 years that's taken out on day one and then repaid over 16 quarters. Uh-oh. Where's my, what page was I on? Sorry guys. Did I already do this? Why does AngelList collect management fees up front? Yes, that's the one I'm on. For administrative efficiency, they hold the fees in escrow and then pay them out over 16 quarters to the GP. Determining whether to commit cash or make a cashless contribution to your fund. The standard GP commit. Under the typical model, a GP would subscribe for an LP interest in the fund and contribute cash towards its interest, much like an LP. So typically, when you're raising, say, $1 million for a fund, you as the GP would, from day one, take $50,000 perhaps out of your bank account and throw that in as your commitment to the fund, just like you were any other LP. Why? It's simple and shows LPs that the GP has skin in the game. What are the risks? Well, if the fund is not profitable, the GP loses to the same extent as the LPs, which is a good thing. You want to have skin in the game. Or you could do a cashless contribution. Under the cashless contribution approach, a GP would waive all or a portion of management fees to fund a subscription by the GP for an interest in the fund. The entire amount of waived fees would be treated as deemed contributions to fund the GP's interest. Why would a GP do it? Cashless contributions have 2 main potential benefits. 1, cash flow. Conserves cash by 1, eliminating the need to fund capital contributions ahead of the receipt of management fees, and 2, deferring tax liabilities on foregone management fees until the fund makes distributions. And 2, tax optimization. Reduce management fee income that is taxed as ordinary income and increase capital distributions that may be taxed as long-term capital gains. What are the risks? General risks. If the fund does not return LP's capital contributions, the GP will receive neither the waived fees nor a return from the fund, i.e. GP gets neither fees nor carry if the fund returns less than 1x. Tax risks. There are IRS and industry guidelines for when they will respect cashless contributions of management fee waivers. There may never be an assurance that the IRS will not take issues with cashless contributions. There is uncertainty and tax risk here, and GPs should consult their own legal counsel in making a determination on waiving a portion of management fees for an interest in the fund. Important note, all GP cashless contributions of management fee waivers into fund contributions must be made before the first close of the fund. So before the quarter one launch, at the start of the fund, when you set it up. Comparison of standard commit versus cashless contributions. Let's see. Okay, for a standard commit, do we have to invest cash in advance of receiving fees? For a standard commit, yes. Although alternative commitment structures to match management fees and capital contributions could be used. For a cashless contribution, no, the GP interest is funded by the waived fees. Are the management fees taxable as ordinary income? Yes, for a standard GP commit. No, for a cashless contribution. Is the GP interest taxed as long-term capital gains? Yes, assuming the LTCG holding period is met. LTCG, long-term capital gains holding period is met. And that's for both. When is income recognized for tax purposes? Under a standard GP cash commit, income for management fees is recognized in each year paid. Under a cashless commit, income generally recognized in the years when there is an exit. Do GPs have to waive their entire fee? Well, it's not applicable for a standard cash commit. For a cashless commit, no, we can waive only a portion of the fee and reduce their investment amount and receive the rest in cash. Can we change approaches later? For a standard cash commit, no, the waiver must be elected up front. And also for a cashless commit, no, you must set up the fund with the structure. So with these cashless commits, this is something that you're seeing different GPs offer as kind of an incentive or a way of sweetening the deal for their LPs. You have some GPs who are saying, like Sean Puri, who waives management fees entirely. You know, a benefit of joining Sean Puri's rolling fund is that he will not take management fees out of your money, which actually adds up to quite a bit, because as we saw, that 2% fee is actually 20% per quarter. And then other GPs, I believe Sahil, in fact, we'll take a look here. Sahil Rolling Fund. Other GPs are accepting management fees, but piping all of those fees back in as their own interest in the fund. Let's see if Sahil mentions this here. Aha, GP commit. Sahil will satisfy his GP commit in part by waiving 60% of management fees otherwise owed to them as the fund. So Sahil is taking 25%. Is taking a 2.5% management fee, which actually works out to 25% of contributed capital per quarter. However, he's then sending 60% of that, which would be on $1 million quarter, which I believe he's collecting more than $1 million per quarter in investment. But for round numbers, on $1 million quarter, Sahil is collecting over the course of 16 quarters, $250,000 in management fees. But then he is spending 150 of that, 125 grand of that he's putting back into the fund as his own interest. So that's a nice way of sweetening the pot. Sahil still gets management fees. He still gets some cash for his time. But for the most part, your money as an LP is still going back into the fund. Sahil is drinking his own water. Now, I'm not going to make any comment on anything regarding to taxes. I am not an accountant. I'm not a lawyer. I am a marketer and someone who's very interested in rolling funds. So I'm not going to comment on any of the tax things here because that would be irresponsible. But I do think that it's very interesting that AngelList has set up a opportunity where GPs can stay in the fund, have their money in the fund, show LPs that they have money in the fund every quarter without risking money up front. Traditionally, when you're raising a venture fund, whatever the GP's interest is going to be will have to be contributed up front. You're going to be down that money until the fund returns it years later. Whereas with this cashless commitment structure available to rolling funds, you can start a GP can start a fund with zero money at all. Every expense you have can be paid through the money that you raise. The AngelList fee is a percentage of the money you raise. The different regulatory filing fees are taken out of the money you raise, and your own commitment is taken out of the money you raise. So there's a very little level of personal risk when raising a rolling fund. Now, you can have a debate as to whether that's a good thing. Maybe you want your fund manager to have a higher level of personal risk in the fund. But you can't deny that by lowering the risk here, you're making a fund management accessible to a greater number of people. Well, guys, I think that we are at around the half-hour mark. I'm trying to make each of these lives shorter and shorter and shorter, make them punchier and punchier, and compress the information into a more digestible package each time. So I'm going to end it here. I am Daniel, the Rolling Fund Guy. Follow me on Twitter for more about the marketing, promotions, and launches of rolling funds and syndicates and other 506c publicly solicitable funds. If you see yourself as one day wanting to be a fund manager, to launch a fund, either full-time or as a hobby, follow along. For, as far as I know, I am the only account on the internet who's consistently producing information about how to grow, market, and launch rolling funds. Thank you so much for listening.